Most people spend their entire lives chasing after money. Yet very few actually understand the simple principles that lead to lasting wealth. In this fast-paced world, where everyone seems to be looking for shortcuts and instant gratification, there are a select few who know that true wealth is built over time. Slowly, deliberately, and with discipline. What if I told you that there are 7 timeless rules that billionaires follow? Rules that they keep to themselves, because they know the secret isn't about fancy strategies or fast moves. It's about the simple, often ignored truths that can build real wealth over decades. The most successful investors I know, myself included, don't look for shortcuts. They don't chase trends or try to time the market. They've learned that wealth is about patience, consistency, and making the right decisions when the time is right. These 7 rules, which I've lived by for decades, have helped me, along with many others, build wealth that has stood the test of time. They might seem too simple at first, too basic to be truly valuable. But I promise you, the simplest ideas often lead to the greatest outcomes. If you truly want to build wealth, these are the principles you must understand, and most importantly, apply consistently. In today's world, I see a lot of people struggling financially, especially those who are new to investing. They want to get rich quickly. Who doesn't? But the problem with that mindset is that it leads to poor decisions. Too many people fall into the trap of trying to pick the next big stock or buy into the latest trend without understanding what they're really investing in. I've witnessed countless individuals rush into investments, drawn in by short-term excitement or a fear of missing out. They see a stock soaring and think, if I buy now, I can make a quick profit. Or they see everyone else diving into a hot new trend and feel like they must do the same to avoid being left behind. This kind of mindset leads to impulsive buying and selling, trying to time the market, and in many cases, ending up with losses. But what most people don't realize is that wealth isn't built in a day. It isn't about quick wins. It's about making thoughtful, informed decisions over the long term. That's where the 7 rules come into play. These rules are timeless because they focus on patience, discipline, and smart decision-making. If you're serious about building wealth, you need to take a step back and think long-term. Don't be swayed by the chaos of the moment. These principles have stood the test of time for a reason. They work. Rule 1. Focus on long-term value, not short-term gains. I can tell you how many times I've seen investors lose their way because they got too caught up in short-term thinking. The stock market is full of noise. There are constant headlines, constant updates, and constant price swings. But the thing about these short-term movements is that they don't matter in the long run. When I first started out in investing, I made my fair share of mistakes. I wasn't always the calm, long-term thinker that I am today. But over time, I realized that the real money is made by investing in businesses that are going to be around for years to come. If you're constantly reacting to short-term price movements, you're not making investments, you're speculating. Investing isn't about chasing hot stocks or buying whatever everyone else is buying. It's about finding companies that you believe will continue to grow year after year, no matter what's happening in the market today. When I invest, I ask myself one question: will this business still be valuable in 10 years? If the answer is yes, then I'm comfortable holding on for the long haul. This mindset has made all the difference for me. If you want lasting wealth, don't focus on short-term gains. Focus on long-term value. The compound effect of holding on to solid investments over time is where the magic happens. Rule 2, don't rely on borrowed leverage. The use of borrowed money can be tempting, especially when you see others making quick gains. But I've learned from experience that relying on borrowed money is one of the quickest ways to get into trouble. In fact, I made a major mistake early in my career by borrowing too much. I was young and thinking about making quick profits. But what I didn't realize was that debt doesn't care about your timing, your strategy, or your plans. When the market turns, and it inevitably does, you'll be left with the bill. I've seen many investors who got into debt to fund their investments, only to find themselves trapped when their positions turn against them. The thing about borrowed money is that it compounds not in a good way. It compounds the risks. Over the years, I've learned to keep things simple. I invest with my own money and avoid taking on debt when making investment decisions. I don't leverage my investments because it adds an unnecessary layer of risk. Now, that's not to say that debt can never be useful, but when it comes to investing, I found it is far safer to rely on your own capital, especially if you're just starting out. You'll sleep better at night, and you'll avoid putting your wealth at risk. Rule 3. Invest in what you understand. One of the most important lessons I've learned over the years is to only invest in businesses that I understand. I don't chase trends or try to jump into sectors just because they're popular. In fact, I passed on many opportunities because I didn't fully understand how a business worked or how it made money. If you can't explain a business in simple terms to a friend, then you probably shouldn't invest in it. That's how I've always approached my investments. I stick to companies and industries that I can understand. Companies whose business models are simple, clear, and predictable. The more complicated an investment seems, the more wary I become. Take, for example, the companies I've invested in over the years. I've invested in insurance, railroads, consumer goods, and even energy. These are all businesses I understand well. I don't invest in companies simply because of the next big thing or because they're in a hot sector. I invest in businesses that make sense to me, that I can understand down to the core. And that's a principle I live by. If you don't understand a business, don't invest in it. Stick to what you know, and you'll make better decisions. Rule 4. Be fearful when others are greedy, and greedy when others are fearful. This is one of the most valuable pieces of advice I've ever shared. The market can be an emotional place. When everyone's optimistic and prices are high, it's easy to get caught up in the excitement. But that's usually when it's time to be cautious. When everyone is greedy, it's a sign that you should be fearful. On the flip side, when the market is in panic mode, when people are selling out of fear, that's when the real opportunities often present themselves. This is exactly what I did during the 2008 financial crisis. The market was in free fall, and there was widespread panic. Everyone was selling everything they owned. But instead of following the crowd, I saw an opportunity to buy good businesses at a discount. And let me tell you, those decisions paid off handsomely in the long run. The lesson here is simple. The crowd is often wrong. When others are acting out of greed or fear, take a step back and evaluate things carefully. Don't be afraid to go against the grain when necessary, but always stay disciplined. This is how you separate yourself from the crowd and make decisions that will pay off over time. Rule 5, patience is more important than speed. Patience is perhaps the most underrated virtue when it comes to investing. So many people want to get rich quickly, but real wealth isn't built overnight. The most successful investors I know are the ones who understand the power of patience. They don't rush into decisions, and they're not driven by fear or excitement. They wait for the right opportunities, and when they find them, they act decisively. One of the reasons I've been able to build wealth over the years is because I've been patient, even when it hasn't been easy. In fact, one of the best pieces of advice I can offer is this: don't try to rush your wealth building journey. Take your time, let your investments grow, and don't expect instant results. I've made many successful investments over the years, but I've also had to wait years, even decades, for some of those investments to truly pay off. The real key is to focus on the long term and avoid the temptation to try and time the market. You see, wealth isn't just about making the right investments. It's about making those investments and letting them mature over time. So take your time. Don't worry about missing out on the latest trends. Focus on the long-term growth of your investments and let patience work for you. Compound interest is powerful, but it needs time to truly show its value. Rule 6, don't overcomplicate things. Sometimes the simplest strategies are the best. I've seen so many investors overcomplicate their approach, chasing after complex financial instruments, trying to time every market fluctuation. and building convoluted strategies in hopes of beating the market. But I've learned that overcomplicating things can lead to confusion and costly mistakes. When I first started out, I read books, talked to experts, and learned as much as I could about the market. But one thing became clear. The more I simplified my approach, the more successful I became. At the core of my strategy is a simple idea. Buy good businesses at fair prices and hold them for the long term. That's it. There's no need to overthink things. You don't need to use every financial tool available, and you don't need to react to every market movement. In fact, the more you try to control every detail, the more you risk losing focus. Keep your investment strategy simple. Focus on what you understand. Invest in businesses that have strong fundamentals, and let time do the work for you. The simpler you keep things, the better you'll sleep at night, and the more successful you'll be in the long run. Rule 7. Surround yourself with the right people. As much as investing is an individual pursuit, I've learned that you cannot do it alone. Surrounding yourself with the right people is essential. I've been fortunate in my career to have had amazing partners, mentors, and advisors who have guided me along the way. The people you surround yourself with, whether in business or in life, can have a profound impact on your success. When I first started, I didn't do it by myself. I had Charlie Munger as a business partner, and together we built Berkshire Hathaway into what it is today. But it wasn't just about finding smart people. It was about finding people who shared the same values and long-term vision. We didn't always agree on everything, but we respected each other's judgment and had complementary skills. That kind of partnership, built on trust and mutual respect, was crucial to our success. You don't need a massive team of experts to be successful in investing, but you do need a small group of people you trust. Seek out mentors, people who have the experience and wisdom to guide you. Build a network of individuals who have the same mindset and who value the long-term journey as much as you do. You'll learn a lot along the way, and their support will help you weather the inevitable ups and downs of investing. Let me share a quick story about patience. Many years ago, I invested in a company called See's Candies. At the time, it wasn't the biggest company, and it wasn't going to revolutionize the world, but I believed in its business model, its strong brand, and its loyal customer base. The market was skeptical, but I could see the long-term potential. For years, I held on to that investment, letting it grow slowly and steadily. It wasn't flashy, and it wasn't making headlines, but it was making money, and it continued to do so for decades. Looking back, I realized that See's Candies wasn't just a great business. It was a lesson in the power of patience. The value of the company didn't show up overnight, but when you give a good business time to grow, the rewards can be incredible. This is how I've approached all of my investments. Whether it's See's Candies, Coca-Cola, or any other company in my portfolio. It's about finding good businesses, investing in them with patience, and then letting them grow. Over time, those investments compound, and you end up with something much bigger than what you started with. Here are a few simple takeaways that you can apply to your own investing journey today. Don't get caught up in the noise. Focus on long-term value, not short-term trends. Don't be swayed by daily fluctuations in the market. Avoid using borrowed money. Rely on your own capital when investing. Don't take on debt that can jeopardize your financial security. Keep things simple. Invest in businesses you understand. Avoid complex strategies and stick to what you know. Be patient. Wealth is built over time. Trust the process, and let your investments grow slowly but surely. Remember, these principles are timeless. The more you can embody them in your investment approach, the more likely you'll be to build lasting wealth. If this video helped you think more clearly about how to approach your financial future, I encourage you to stick around. On this channel, we focus on wisdom that stands the test of time, investing with patience, discipline, and long-term vision. If you'd like to learn more, consider subscribing. No pressure, just honest advice to help guide you on your financial journey. Building wealth isn't about speed. It's about making the right decisions, with the right principles over a long period of time. If you stick to the basics, stay disciplined, and embrace the power of patience, you'll find that the journey itself is just as valuable as the destination. Take it slow, stay steady, and the results will follow.